How do transaction costs affect portfolio rebalancing strategy? Have you ever wondered how transaction costs can shape your investment decisions? Let's break down how these costs impact portfolio rebalancing strategies. Portfolio rebalancing is the process of adjusting your asset allocation to stay aligned with your financial goals and risk tolerance. However, every time you buy or sell an asset, you incur transaction costs that can eat into your returns. At the core, transaction costs include brokerage fees, bid-ask spreads, and taxes, particularly capital gains taxes, when you sell assets that have appreciated in value. For instance, if you sell an asset you have held for less than 1 year, you may face higher short-term capital gains taxes. This can make selling high-performing assets less appealing due to the costs involved. Frequent rebalancing can lead to accumulating these costs, which is why many investors choose to rebalance less often. Instead of rebalancing every month or quarter, many find that doing so annually, or when their asset allocation drifts beyond a certain threshold, is more efficient. This method helps to minimize unnecessary trades while still managing risk. The choice of rebalancing methods is also influenced by transaction costs. Some strategies focus on maximizing the expected utility of wealth after accounting for these costs. This means that investors may only rebalance assets whose allocation drift is significant enough to justify the transaction costs involved. Practical strategies for managing transaction costs include using tax-advantaged accounts like individual retirement accounts to rebalance without immediate tax consequences. Setting tolerance bands for asset allocation drift can also help trigger rebalancing only when deviations are meaningful enough to outweigh the costs. Additionally, consider the opportunity costs of rebalancing. Selling a high-performing asset too early can mean missing out on further gains. Holding cash temporarily during rebalancing can also lead to lower returns. Finally, it's essential to evaluate the transaction costs specific to your investment vehicles. Exchange-traded funds, mutual funds, and individual securities can have different explicit and implicit costs. Understanding these can help you make more informed decisions about when and how to rebalance. By carefully managing transaction costs, you can create a disciplined rebalancing strategy that helps maintain your target asset allocations while preserving your portfolio returns. This approach aligns well with specialized wealth strategies and long-term investment planning, ensuring you stay on track toward your financial goals.